What is going on, guys? Welcome back to the channel. Hope you're doing well. And understanding quantitative easing is a must for anybody who wants to invest in risk assets. Of course, it's equally as important to understand quantitative tightening. And in this video, I'm going to talk about how it's going to affect us, what to look out for, the current battlegrounds within the Fed, and who's going to be the next Fed chair. We're going to look into all of that and how it's going to impact our bags. So smash a like, guys, and welcome back to the channel. So the global financial crisis of 2008 introduced us to a new system of course, quantitative easing. Now, the banks were borrowing. I remember the time, growing up in the UK, Royal Bank of Scotland, many banks falling, sub-mortgage prime market. And the Great Recession of 2009 and the subsequent economic crisis, obviously some people are saying we are almost there yet again and the system has to break. So one thing I want you to understand while we go through this new shift, of course, is something catastrophically breaks for them to open the printers. And of course, a lot has been breaking up. You can see here, we are now after the ADP report today at 80% plus. So let's listen to this.
Good morning, Nicole. Yeah, the ADP private payroll data really, if you think about it, crystallized what the Fed needs to be focusing on going forward, and that is the labor market. So the ADP private payroll data, negative 32,000 jobs, and this was a report focused on small business, Nicole. If you look at the numbers, businesses from 1 to 39 or 1 to 19 lost 46,000. 20 to 49 employees lost 74,000. So that's 120,000 job losses in small business. Medium and larger did well. Medium, 50 to 249 gained 31,000. 250 to 499 gained 20,000. And companies 500 employees and over gained 39,000 jobs. Now, let's break this down by industry. Construction lost 9,000, manufacturing lost 18,000, information lost 20,000, financial activities, professional and business services lost 26,000. The biggest gainer, education and health services, gained 33,000. And if you're looking at the inflation aspect of this report, wage data was weaker than expected. Wages for job stayers went from 4.5% last month to 4.4%. Bigger change for job changers, 6.7% to 6.4%. So again, jobs weaker than expected, wages, the inflation data here, lower than expected. So this gives the Fed another reason to not focus on inflation, wages lower, and focus on the labor market, jobs lower than expected, Nicole.
So we don't actually have the full data, but one thing we do have is the ADP, and hence why the Fed absolutely must focus with AI, with everything that's going on, people losing jobs. I think it's inevitable that they are going to be doing everything they can to prevent a great recession and therefore prepare, which they've already announced, for a soft landing. Okay, so that part we know something has to catastrophically break in the system for them to be able to pivot and us to understand how this is going to be impacting us as the dollar printing comes. Now, in addition to that, we've seen several rallies. Of course, we have Christopher Waller versus Kevin Hassett. Kevin Hassett is in the private driving seat. This is the most bullish appointment for crypto in the asset class's history. He is on the board of Coinbase. He is absolute integral to Trump's crypto policy, and I believe other people don't actually want him. They prefer Christopher Waller. I do believe Kevin Hassett has what it takes to be one of the best Fed chairs for crypto, especially after taking office in September, leading up to midterms. So you get the picture. both of these guys are dovish. Obviously, Hassett will be the preferred choice by the market. And of course, this guy's got a massive background in terms of educational. He's obviously well established amongst the Republicans. And of course, he's currently also holding an important role in the Trump administration. Now, in addition to that, 5 candidates shortlisted. Okay. So you got Fed Governor Walsh, you got Governor Waller, you got Vice Chair Bowman, of course. You also got BlackRock's Reader. I believe the markets, the analysts, obviously, everybody's identified the front runner as being Hassett. This guy obviously holds a PhD in the economic matrix, applied economic matrix to be specific. So this guy has a history of being incredibly dovish and incredibly proactive when it comes to writing some of the bills, proposals. And if he comes in as a crypto-friendly chair, I think it's going to do us the world of good. He advocated several times for 50 basis points cut in December. His core believes our inflation battle is effectively already won. And he is a supply-side politician with policies that enable growth without inflation pressure. So he doesn't even agree with the the current chair that the inflation situation is as bad as obviously they make it out to be. So he's going to be somebody who comes in again. He's obviously got negatives as well, and that leads me on to one thing. If you look at this whole idea of quantitative easing versus quantitative tightening, okay, we are retailers, man. We don't understand these things, but it's good to know how these things work and how quickly liquidity comes into the market. Yeah. So end of QT, for example, July 2019, the Fed stopped shrinking balance sheet, and then quantitative easing started to a degree in September 20. So July was the end of QT. September was the start of QE when they started buying treasury bills, of course, to stabilize the repo market. Yeah, we already know that there was an injection of $6 or $7 billion into banks a couple of days ago. So we already know they are doing a form of quantitative easing. Of course, they are refilling these repo facilities as well for banks. That's very, very bullish. Okay. Time gap, roughly, I'd probably say 6 weeks, 8 weeks. It could be longer. So anything between a month, 4 weeks to about 12 months. But there are variant, of course, it depends on what breaks. I can see the labor market even getting worse over the new year, right? January, February, I could really see this being a time when the Fed steps in. But also I am prepared to wait for the eventual outcome of the Fed's next appointment and see what policies they come in with. So this is a liquidity for, if you can think about a completely uninsured deposits, credit lines, liabilities, all kinds of stuff. Quantitative tightening basically drains liquidity out of the system. Okay. When QT started, banks did not shrink their risky liabilities. Of course, there are hidden risks in that as well. But we are standing on a pivot of the 2025, December the 1st, ending of QT. And notice that Powell, obviously, it's a blackout week, 7 days before the next FOMC. So obviously no one's allowed to talk about any market related, it's blackout basically, Fed blackout week. So you've seen the odds now at 89%. One thing that is absolutely critical here is they've hit the brakes on this situation. Now, once they hit the brakes, then you start to get things like ADP. And already since the height of 2022, when they introduced quantitative tightening after COVID prints, they've obviously drained 2.39 trillion from the assets, right? And of course, two competing views emerge for what happens next. the bull case, right? So increased liquidity and fairly quickly. And of course, a rally in risk assets, similar to what happened in 2019, but more so in what happened during the pandemic. And the bear case is that the market stabilizes, the labor market stabilizes quicker, and it takes a lot longer for this to come into fruition, and banks recover quite quickly, and we move on. The chances are with housing, right, with credit cards, with loans, you're starting to see all of this translating into weaker labor market, and of course, people don't have any money. And what tends to happen is, because people don't understand the delay between QT ending and QE beginning, what people tend to do is they will say, oh, you know what, it's not going to happen. It's not going to happen. Of course, it's always going to be risky to sit in, volatile assets like altcoins. But next year is the one, in my opinion, that is everybody's main year of complete and utter market bonanza. We've not seen that. Bitcoin sitting at 92 and some change, 400. I genuinely believe when that pivot comes, when people start to understand that they need to avert this, right? There's a very thin line between what the Fed has to do in terms of the inflation side of things and the labor side of things. And labor has been decimated by majority AI is just killing it. So the question is, who would we want to be the next Fed governor? I'm okay with both of these guys. I think they are both very capable. And with the midterms coming, obviously Republicans need a good economy to do very, very well. Okay. But going back to my thesis about what's about to happen in terms of understanding this whole, this whole quantitative tightening versus quantitative easing, and how we get past the current levels of basically the market is completely lost it, right? So here's what we're gonna see in the 2020 pivot that was done in an emergency after a catastrophic pandemic. QT was ended. 2019 QT already ended. The balance sheet was going slightly from the not QE to repo operations. Full QE started on the 15th of March, 2020. Massive open-ended asset purchases, right? And if something breaks, and they will allow something to break, honestly, there's going to be immense pressure in the market. So something will collapse, banks or I don't know, housing market, something will start to show even more stress than just the labor market. So the time gap effectively was zero, because from the last period of genuine balance sheet reduction, which was mid-2019, this was an immediate emergency response because of the pandemic. Now, there is no standard waiting time, okay, to go from this to the bull case or the bear case here. But this is genuinely bullish because they are printed money. And in my opinion, they don't have to announce it. They could already be doing it. And of course, we've seen some banks getting money very, very recently. So in short, historical gap between QE and QT, or QT and the start of the next QE, is mostly measured in months, not years. Okay. And it's almost instantaneous as and when they need that facility. Okay. The switch is reactive and it's not scheduled. So roughly 1 to 2 months, maybe sometimes 6 months to a year, absolutely at the end of, in my opinion, day. Let's watch what the labor market does. Inflation, in my opinion, with the cooling of the tariff talks, even though Trump brings it back every now and then, I think will be forgotten very quickly if the labor market continues to break down. So let me know your thoughts. Let me know if you're in favor of Waller or if you're a Kevin Hassett fan. I think both of these will be absolutely amazing for the space. They are both very dovish, and I think we could look forward to a great 2026, in my opinion. As far as this crypto market is concerned right now, it's a pump and a dump, a pump and a dump. You know, that is how you need to look at it. Now, what I would say is, if you've obviously, the best asset you could have is some kind of regular job, just DCA. You know, it doesn't matter if you buy Arweave at $4 and you buy the next one at, I don't know, $1.50 or $3. Get a good average. All right, guys? Let me know what you think of the video. And of course, I will catch you on the next one. God bless.